Hey guys, my name is Mike Boyd, this is the Money Flare, and today I want to show you guys how you could predict the next market crash. And it's not some crappy indicator that I'm trying to sell. It's a very simple tool that you guys can use, that anyone can use, that can help you determine when we might see another recession and when we might see another market crash. And I think it's an important tool that everyone should know and that everyone should understand. So today I'm going to be talking about the yield curve. But before that, I should probably mention or clarify what a bond is and what a yield is. So a bond is basically just like a loan. So when I'm buying a bond, I'm essentially loaning my money out to whoever is issuing that bond, whether it be a government or a company. So for example, let's say I buy a government bond. What I'm essentially doing is I'm lending my money to the government, I'm receiving regular interest payments, and then when the bond matures, so when the bond is over, I receive my money that I initially lent, which is called the principal. And that's the basics of what a bond is. Bonds are often referred to as fixed income in sort of the investment financial space, but it's basically just debt. The two most important concepts that you have to understand when buying a bond are the maturity and the yield. The maturity is basically just the lifespan of the bond, so it's how long you're lending your money out to the borrower. And it can range anywhere from a few months to 10, even 30 years. The second most important concept is the yield. The yield is basically just the interest rate that you're making. So for example, if I buy a 10-year government bond that yields 2%, that means that I'm making a 10% interest on that bond for 10 years. So every year I'm making 2% a year for 10 years until the bond matures, and then I get my principal back. Another important concept to understand is the price of a bond and its face value and how that might change over time and depending on market conditions. So the face value is just sort of the price of a bond that you're buying. Usually it's priced at around $100 or $1,000 per bond. And this is the value that the bond has as when it's issued. And all the yield calculations, for example, are done based on this face value. But bonds are traded in the open market. And much like any other investment, its price can move based on market conditions. So the price of a bond can change from the face value depending on such things like maturity, as well as, and most importantly, interest rates. Bond prices and yields, or interest rates, act sort of like a seesaw. And much like any other investment, it reacts to supply and demand. So when people are buying bonds, the price goes up and yields go down. Whereas when people are selling bonds, the price goes down and yields go up. Let's look at an example to see how this relationship works. So let's suppose that I buy a 10-year government bond that yields me 2%. So if I were to hold this bond for 10 years, I'd make 2% every year until the bond matures after 10 years, and then I get back my principal. And so if I were to sell that bond now, so let's say I buy it, and then a week later I wanted to sell it in the market. The price of that bond really wouldn't change much from the face value because, it's just been a week and most likely interest rates aren't moving and the bond hasn't aged much. So the bond is going to sell for face value. But let's say now that I hold on to that bond for 3 years, and in that 3-year time frame, interest rates fall from 2% when I initially bought it to 1%. Now in this situation, if I were to sell my bond in the market, that price becomes, or that bond becomes much more valuable. So the price goes up because now I'm selling a bond that has a 2% yield when interest rates have fallen to 1%. And so any investor willing to buy bonds is going to see that bond that I'm selling and value it much higher than any bond that is being issued at a lower interest rate at 1%. And the same thing works in reverse. So let's say interest rates, instead of falling, now interest rates rise since the time I buy that bond, and they rise to 3% when I bought it at 2%. Now when I try and sell my bond in the market, my bond that's yielding 2%, it becomes much less valuable to investors because they can get a bond that yields 3%. So that's sort of how yields and bond prices work. And it's just, the important thing to remember is that it works sort of like a seesaw. In my previous video, I mentioned that central banks control interest rates. But that's not the whole picture because central banks only control one interest rate, which is the overnight rate. And it's usually the lowest rate that you can get, and it's used by banks with each other in the overnight market. So it's not even an interest rate that most people have access to. It's really mainly for banks. But all the different debt maturities have their own interest rate, they have their own yield, and those yields are determined by the bond market. As I said before, bonds trade in the open market. and their price and yield change depending on supply and demand dynamics. So if people buy bonds, yields go down and price goes up. I've sort of already mentioned all that, but one thing to keep in mind is that, or to always remember, is that there are different maturities of bonds, right? And so investors are buying certain maturities, sometimes could be buying certain maturities more than others. And each maturity of bond has its own yield. So a 1-year bond has a different yield than a 5-year bond or a 10-year bond or a 30-year bond. And so this is how the bond market sets yields. And more importantly for this video, this is how the bond market determines the yield curve. So the yield curve is simply charting all the bond yields from shortest to longest maturity. And as the name implies, it has a sort of curve to it. So as you would guess, the shorter term bonds have lower yields usually than longer term bonds, because it's only natural that if I were to lend my money to the government, let's say for 1 year, I should be making a lower yield or a lower interest rate than if I lend the money for, let's say, 10 years. And so that's usually the shape in a healthy economy. That's the shape of the yield curve. It has that sort of rising curve to it. But the yield curve changes. The shape of the yield curve changes depending on market conditions and depending on economic conditions. And so when that yield curve starts to flatten and then invert is when you have to really be on high alert for the potential of a recession coming along or the potential of a market crash. In order to better see this, let me show you an example on my computer. So if you were to Google the yield curve, you could find probably some pages from the Federal Reserve or some other links to show you what the yield curve currently is. But the website that I really like is called Guru Focus. So it's gurufocus.com/yield_curve. You could just Google Guru Focus yield curve and you'd find it. And what this is showing you, so I'll scroll down. Here on the left, I'll show you first this on the left. What this is showing you is in blue, the current yield curve. So you see how that looks like a very healthy yield curve. You have the shorter dated maturities yielding lower than the longer dated maturities. So in this case, the 1 year is yielding 0.06%, the 10 year is at 1.67%, and the 30 year at 2.32. So this has that curve shape that I mentioned. And what this part of the website also shows you is what the yield curve looked like in the past, in certain moments in the past. So here in April 2019, you can see the yield curve wasn't looking that good. It was actually partially inverted here. So the shorter dated maturities were yielding more than the sort of midpoint maturities, 3-5 years. So at that point in April 2019, you can make a higher yield loaning your money to the government for 3 months than you could for 3 years. And so as you would imagine, that doesn't really make much sense. And that kind of tells you that there's probably some worrying signs going on in the economy. It wasn't fully inverted because the longer maturities were higher, but this is what it was in April 2019. And anyway, this part just shows you the yield curve at different points in time. On the right here, this shows you the yield curve over a longer time frame and how the inversions have always preceded recessions. So in this case, it's saying it's predicted the past 7 recessions. And what this is this is the 10-year and 1-year spread. So you're taking the 10-year yield and you're subtracting it from the 1-year yield. And when that subtraction goes below 0, so when the 10-year is yielding less than the 1 year, that's when the yield curve is officially inverted, meaning you're making more money lending your money to the government for 1 year than you are lending your money to the government for 10 years. And as you can see in the past, right, and here in this graph, all the shaded regions are recessions in the US. And as you can see in the past, right, every time that the yield curve has gone below that 0% level, so every time it's inverted, every time the 10-year has yielded less than the 1 year, we've had a recession afterwards. So it happened here in the 70s, it happened here. Here the yield curve was kind of going crazy with interest rates in the 80s, but it happened here in late 80s, happened here again before the tech bubble. It happened right before the 2008 crisis in May 2007, or roughly before, so February 2006. And it happened most recently in April or June, let's say summer 2019, August. August 2019 is when it happened most recently. And you would probably wonder, well, okay, the yield curve inverted in August 2019. That was way before we even knew what COVID was, right? Well, that's one thing to keep in mind. The economy really wasn't doing well before COVID. There was some worrying signs in the economy. It was looking like it was slowing and rolling over. And so in August 2019, the yield curve officially inverted, which was predicting a recession in the near future. And in this case, COVID sort of is what got the ball rolling, but we were headed into recession regardless of COVID. At least that's what the yield curve was saying. Just below is the 10 2-year spread. So there's different ways that you can look at the yield curve, and when it inverts, you can compare different maturities. I like to compare the 10 and 2-year spread, and I also like to compare the 10 and 3-month spread. And I'll show you a bit later on my charting platform how the yield curve inverts and how the market looks after inversions. But here's the graph of the 10 and 2-year spread, and it's a similar concept, right? The yield curve is inverting right before recessions. Economies move in cycles, right? We have cycles where we have periods of time where the economy is growing and rates are going up, growth is increasing, and then we have naturally a slowing in that growth rate and a slowing in that growth of credit. And then we have these down cycles where then we have growth rate slowing even more, potentially even going into negative territory, which would be a recession or depression. And we have negative credit growth rate. And so the yield curve sort of follows this regular business cycle of the economy. And so below this graph, you'll see actually sort of the mechanism of how the yield curve is inverting. Because, right, the yield curve can invert that spread, let's say between 10-year and 2-year, it can go to zero and go lower than zero or in two ways. It can go because the 10-year yield is coming down to meet the 2-year yield, or it could happen if the 2-year yield is rising to meet the 10-year yield. So that spread can go towards zero in a few different ways. And so this graph here is just showing you the specifics of how the yield curve is inverting in these cases. And so this is the long-term trend. Here is the S&P 500 in blue, and then in green is the 10-year yield, and in in black is the 1-year yield. So now I want to show you guys how the yield curve looks with respect to the market. And usually when we have a recession, we have a pretty significant market crash, right? We have usually a 30 to 40 to 50% crash in the market. And that's what I'm plotting here. So this here is the 10-year, 2-year spread, so that spread that I mentioned that I like to chart. A lot of people look at that 10-year, 2-year spread. So that spread here, I'll make it in blue just to make it a bit easier to see. So that spread is in blue. I'll hide everything. There we go. So the yield curve here is in blue, the market's in orange, and here I've sort of signaled where the yield curve inverted and when we have a market crash. So I'll zoom in on each instance here. So in this particular case, this was right during the tech bubble. So the 10-year, 2-year spread inverted right here, early February 2000. That's when the yield curve first inverted, and it stayed inverted all the way up until roughly December 11th. But at that point, the market was already crashing, right? The market had already started its decline, which was a pretty significant one. But as you can see in this case, the yield curve was roughly it was only, let's say, 6 or so months before the actual top in the market. So in this case, right, the yield curve inverting was a very good sign for people back then to see that, okay, things are not looking good. Maybe I should sell some of my stocks, hold some more cash, right? Whatever you want to do to reduce your risk. It was a good sign in this case that something was going on. And usually if you want to try and time it even more, the yield curve inversion, the first time it inverts, is usually not when, as I said, it's definitely not when the recession is happening. The recession is definitely happening sooner to when that yield curve starts to steepen, right? As I mentioned, we have the inversion, the yield curve stays inverted. Most likely then we have a catalyst which brings us into recession. But at that point, the yield curve is then steepening because at that point, central banks are lowering rates. And so when you lower rates, you steepen that yield curve, right? And so when central banks are lowering rates in response to some type of issue going on in the economy, that's when you start to have this yield curve steepening. And that's when now you know you're in the recession. And so in this case, it wasn't that late, right? It was still early. If you did sell your stocks at this point when the yield curve started to steepen, you still did pretty well. It was better than holding it all the way through this market crash. Same thing for 2008. the 10-2 spread here. It inverted early. This time it inverted in February 2006. So that was a good 2 years before we started having the issues is when this yield curve first inverted. And so this was really, really early, right? In this case, if you had sold your stocks in 2006, you would have missed out on some further price appreciation. So, the yield curve is, as I mentioned, the yield curve is never perfect. But in this case, if you had waited for that steepening, as I mentioned here, which is the red line, if you had waited for that steepening when okay, things are happening, then you would have been perfect. You would have sold basically at the top. And the same thing most recently here. So if I just go to the most recent crash, same thing. Yield curve inverted in August 2019. Stocks kept going up afterwards, but when we started to have, it wasn't a very significant bear steepening, but when we started to see that minor bear steepening, that sort of very slow bear steepening, and if you had waited for that sort of steepening to roughly here, December 2019, you would have sold essentially at the top. And so in this case, as long as you just look at the yield curve and what it's doing, you can essentially try and better time your investments in the market. You can't time it perfectly, and no one can time it perfectly, but it's definitely better than sitting through a massive drawdown, right? It's better to reduce some risk when the yield curve tells you to, when the bond market tells you to. Better to reduce some risk and then buy when prices are much lower. And so you may be wondering, why does the yield curve predict recessions anyway? How does it do it? What is it? Is it magic? Why does the bond market consistently predict recessions? And the simple explanation is that bond investors, the bond market in general, is smart. Bond investors are very smart people. They're usually more experienced. They've been in the market for a while, and they know what they're doing, and they know how to sniff out certain issues in the economy. And that's actually one of the biggest takeaways that you can get from this whole demonstration, from this whole video, is that the market in general, the market is smarter than you are. You may have your forecasts for how the economy is going, or you may have your you may have a certain outlook for the economy, but the market is more than just one brain, right? You have one brain analyzing all these things, forming an opinion. The market is a collection of thousands, hundreds of thousands of brains trying to come to a conclusion, which is, are we seeing economic growth, or are we seeing economic slowdown? Are we going into recession, right? There's thousands, hundreds of thousands of brains working on that in the market, whereas your brain is just one. It's just one single opinion. If anything, as an investor, you're more an investigator than you are someone who's trying to call the shots and say, well, I think this is going to happen and this is going to happen. Most investors, most good investors at least, what they're doing is more investigatory work. They're trying to figure out, okay, what is the market telling me in this situation? What is this asset going up trying to tell me? What is the bond market trying to tell me? Or what is the yield curve trying to tell me? So it's just important to keep all these signals, all these signs in mind to make you a better investor in the long run. So to recap, the yield curve is an important indicator to keep in mind to kind of give you an idea, to gauge where we are in the current business cycle and in the current credit cycle. And it's going to be telling you whether or not a recession is likely to come in the short term, or it's going to be telling you whether or not we're at the beginning of a new cycle. So what this means for your portfolio is that when the yield curve inverts, you should most likely be looking to reduce some risk, sell some stocks, hold some more cash, hedge to the downside, so get some downside protection. All these things to sort of prepare your portfolio for a potential market crash. It's not really more complicated than that. It's pretty simple. It's just keep in mind the yield curve, and when it inverts, start to take measures, especially when it inverts and then when it steepens. When it steepens like that, that's when you should really start to sell some stocks, hold some cash, prepare for a potential market crash or market downturn. And so guys, it's really not more complicated than that. It's a very simple metric, very simple indicator to be following. Everyone knows about it. It's often featured in articles whenever it inverts. CNBC, NBC, all these different places report that the yield curve is inverted, and people are aware that the yield curve inverting usually predicts recessions, but everyone, every single time it happens, usually says, well, this time is different, or we're not gonna go into recession now. It happened the same, that's exactly what happened in the summer of 2019, right? People were saying, well, the yield curve inverted this time, but it inverted differently. It didn't invert because short-term yields were going up, it inverted because long-term yields went down, and then that's what caused the inversion. And so this time is different. We're not going to have a recession. And that time, like the previous times, they were wrong. This time is never different. So thank you guys for watching this video. Hopefully you were able to get some useful information out of it that can help you become a better investor in the long term. A lot of people on YouTube especially say that you can't really time the market, but I hope that this video has shown you that you can actually, not the day of the crash, but you can sort of predict when we're going to have some issues going on, when we might see a market crash. It's not as hard as some people would make it seem to be. Predicting the market, you can't predict the market, but you can always have signals and signs that can lead you to a conclusion that maybe we're headed, there's a high probability that we're going to have a crash coming soon. And so, people make it seem as if timing the market is hard and you can't do it. But I'm hoping that I showed you today that you can definitely do it. And you can do it with just a simple indicator like the yield curve. And so, once again, I hope it makes you guys better investors in the long term in order to protect and grow your wealth. So thanks for watching the video. Please be sure to like and subscribe, and I'll see you at the next video.